Welcome back. Today's episode is about long-term investment vehicles and how powerful they are because the equity in these assets typically hold their value over time. People want success and they want it as soon as possible, but most of the time people run in circles trying to chase a quick buck. For example, I typed these keywords into YouTube and here's what I found. Habits of billionaires, millionaire investment vehicles, and investing in index funds. Which keyword got the most amount of views? I was surprised, but here's the view count. 7.4 million views, 2.7 million views, and 120,000 views. These stats are shockingly funny because the content people are searching resided in the category of instant gratification. Billionaire habits, investments that make 100% plus returns, the newest cryptocurrency that'll make you a millionaire if it gets to 5 cents. These are keywords that people search for the fact of instant gratification and to make a quick buck. But why I think this is super funny is because all the while the secret is right under our noses at investing in index funds. Index fund investing is the bottom of the pyramid. Like the bottom of a pyramid, index funds should be your starting building block that stabilizes all your investments that come after it. Index fund investing can be summarized as investing in the entire market. Index funds are a bunch of stocks that can be bought and sold under one index name. There are indexes that invest in emerging markets across Europe and Asia. Indexes can even range from about almost anything. This type of investment will, on average, show you a 10% return on an annual basis. That doesn't mean index funds make money every year, but over long periods of time, that's been the average return. The second level of our pyramid should be dividend-paying stocks. As a 20-year-old, letting quarterly dividend payments compound for 30 years is an investing strategy that almost never fails. I invested my first dollar in Johnson & Johnson at the age of 12 years old. For 8 years now, actually 8 plus, probably like 9 or 10, but my quarterly dividends have stacked up nicely. Not to mention, the stock price has doubled since then. In summary, compound interest and dividend-paying stocks are a key layer to a long-term investor. Now that we have a strong base filled with investments that don't crumble in the wake of a storm, how can we be a tad bit more riskier so we can capture those big gains we see on the evening news? Individual stocks. Apple, Disney, Microsoft, and Netflix are all individual stocks, but their rise to power has already been established. Investing in these individual stocks are like investing in a blue chip stock. You will likely see gains, but these numbers won't excite you. When picking individual stocks, it's advisable to adopt a Wayne Gretzky mentality. Gretzky is famous for saying, "When I skate to where the puck is going, not to where it has been." This is a wildly popular quote because it vividly illustrates something that everyone wants to do, but may not understand how to do it. Here's an example. In 1998, Netflix is still delivering DVDs to their customers' doorsteps. Now, the share price back then was probably I did some research on it and I think I saw it was like $1.80 up to $3. And I think today it's about $500 a share. Now, if you had the long-term mindset and vision to see that Netflix was going to put Blockbuster out of business and that they'd be the number one streaming service in many years to come, you'd be a multi-millionaire. So the point is, just like Wayne Gretzky, you have to try and skate to where the puck is going to be, not where it's currently placed on the ice. Everyone else is furiously chasing around the ice to get to the puck, but if you position yourself in a spot to where you think the puck will be and you're right, man, it'll make all the difference. In the next episode, we will debunk the automated systems needed to grow your money on autopilot.